Tougher capital rules for U.S. banks proposed by the Fed's bar isn't the only thing that investors are closely watching. Earnings season is just around the corner, and the nation's largest banks are gearing up to report their quarterly results. Here with more on what we can expect, we want to bring in Stephen Biggar, Director of Financial Services Research for Argus Research. Stephen, it's good to see you. So certainly a challenging setup here for the banks, a higher interest rate environment. We also have the possibility here of stricter regulations, and the implications of that is something that investors are waiting to see. How does this set us up for this round of earnings season?
Yes, well, I think it's going to be, not banks' finest hour in terms of earnings this quarter. Clearly, the higher rate environment that was very helpful in 2022 for net interest margins is having a detrimental effect now. You've got slowing loan growth, just less demand as you have much higher interest rates here, and that's the intended effect of the Federal Reserve. Net interest margins look like they peaked in the fourth quarter of last year. We're likely to see additional pressure sequentially on margins as deposit rates have really increased quite a bit here as banks try to stay competitive with a lot of higher yielding alternatives out there. And then, of course, on the other bit of lending, the business would be loss provisions. And, we're starting to see some increased delinquencies, particularly in the credit card and auto lending market. So I think banks are going to be conservative here, add to loan loss provisions, and all in all, of course, all three of those will dampen earnings growth a little bit for the quarter.
So you talk about the growth we're likely to see in loan losses, defaults and credit card payments, but we've heard repeatedly about the potential cliff waiting, especially in commercial real estate. What are you going to be looking for, at least in this quarter, in terms of the potential rising risk on that front for banks?
Yeah, definitely. The commercial real estate does, loom as a potential problem area, and we've seen some defaults already kind of pick up there. I think banks did a very good job in the first quarter of laying out the risks there. Typically, for the very large banks, commercial real estate is about 10% of their loan book. Commercial and the office space in particular, which is where a lot of the damage is. And the higher delinquency rates is typically more like 3 to 4%. It's quite a bit higher, about double that at the regional bank level, but still manageable at this point. And of course, the underwriting standards have been better in commercial real estate than they were 5 or 10 or 15 years ago. So that's beneficial for banks. They have generally about a 40 or 60, I should say, 60% loan to value in there, and that gives them a fair amount of leeway should these go south. But clearly, a lot of refinancings are coming due in the commercial real estate space over the next 3 years, and definitely among the highest problem areas that we're watching in terms of delinquencies and credit quality.
Stephen, we know a lot of the focus in the past earnings season most recently have been on guidance. We've already seen a number of the banks, specifically the regionals, already lower their guidance. M&T Bank was one of those names that already lowered their forecast. Do you think we'll see further cuts here over the next several weeks?
Well, I would say, given that we have earnings coming out at the end of the week, banks have gone into a quiet period. We're probably not going to see anything additional drop here. A lot of those that softer guidance came out during some of the conferences they had at the investment bank. So I think we're sort of set for the quarter here. The quarter has ended, but I think the commentary and the guidance and the earnings calls that we get is probably not going to be barn burner either, right? We're probably going to see more of the same. Banks coming into last quarter. They actually, some of them were expecting that the Fed would have been done raising interest rates, by mid-year. That looks not to be the case as you look 3 months later now. Some had expected even a cut by the end of the year. That seems very much off the table now. So I think we're stuck with these higher rates, which will again dampen lending growth and slow the economy further, which is bad for credit quality.
Stephen, still a big concern, the regional lenders, the medium-sized banks we have seen in the spring, those like JPMorgan swallow up First Republic. When you look at the financial space right now, are you expecting more consolidation? Not necessarily failed banks, but just seeing where the banks are, especially the medium-sized banks, and the impact they continue to take from higher rates?
Yeah, I think, and we've seen some support at the regulatory level. There might be some appetite for additional consolidation. I think most would say it's safe to say we're overbanked in the U.S., particularly relative to other countries. We've got about 4,700 FDIC-insured commercial banks in the U.S. today. They all can't make it, I would say, in this environment. I think it behooves most of them to take a look at partnerships and outright acquisitions if they can't do it themselves. That's tough for a bank, obviously, that wants to maintain its independence. They feel they have the right product set for their local markets and so forth. But the regulatory aspects here, what happens with the new, particularly the regulations that are going to be put in place, it's going to make it very hard for banks to compete, for banks to continually elevate. We know that capital cushions only go in one direction, right? And that's up. So they continually have to add more to their capital. Even as they grow larger, you would say it's counterintuitive that the larger banks have to set aside even more. But it doesn't make them safer. It makes them less prone to failure, certainly, and looks better in the eye of the regulators. So I think we'll see more consolidation here. I don't think we're going to have the number of banks the next 5 or 10 years, but I think there's a lot of consolidation that needs to take place.
And Stephen, what is the timeline of that consolidation? Is this something that's going to take years to play out?
Yeah, absolutely. I don't think we're, banks can only take on so much at a time. The large banks, when they do acquisitions that are sizable, I would say about a third of their asset base or higher, they tend to take about a year and a half to do that before they even can look at something even more significant. Smaller size or sort of tuck-in acquisitions that are in the same service territory, that makes sense. Maybe you can do that a little faster. But we're talking years here. And not just a couple of quarters, obviously. It took about 20 years for banks to have the number of banks that we have in the U.S., and it's probably going to take another 20, unless we get some very favorable regulatory environment that actually encourages consolidation, and I don't see that happening.
So, Stephen, given all this, given the very challenging setup, the backdrop that we're in right now, who is best positioned in this environment?
Well, I'd still favor the large banks, the JPMorgans, Bank of Americas, even Morgan Stanley, and some of the super regionals, I would say, like a Truist Financial, PNC Financial, U.S. Bancorp. These are banks that have already largely met or can more easily meet the higher capital requirements. It will take them a matter of quarters, let's say, to no more than 2 years to reach these higher capital levels that are most likely to be in place. And we do expect, of course, the banks did sail through this year's stress test. The CCAR results came in, but those are going to get more stringent going forward. We're going to have a scenario where interest rates spike over the forecast period versus decline, which has been the way it's worked with stress tests in the past. The Basel III international regulations are going to get more strict and severe as well. They're going to add a couple of more nuances to scenarios and what happens with banks, in particular about risk-weighted assets and trading assets as well. So that'll affect the Morgan Stanleys and Goldman Sachs of the world in particular. So I think those are still well positioned. Banks in the kind of 100 billion to 250 billion range, or even 50 on their way to 100 billion, are really going to have a tougher time. So I'd stick with the larger banks. They've got great earnings potential here. They're well diversified. They've got good yields at this point, and of course many of these have suffered in decline. They're well underperforming the market at this point, and create some opportunities for investors.
All right. Well, we'll start seeing these quarterly results later on this week. Stephen Biggar of Argus Research, thanks so much.
Thank you.